Today we had a call. It was like a 2 hour live call, almost 2 hour live call on MCE with Al Qureshi from Blue Water and Gary Yeoman, the CEO of Voxter. And it was a long call because Al Qureshi and his team, I think it was 2 or 3 associates, were on the call and were presenting us the Blue Water solution. Like they were showing us on the screen a little bit of the inner workings of the software, how clients can upload loan documents and how it shows pricing. I mean, it was very educational to see that. And to me, it was really clear why they're excited about the future of this business, because they were like talking about, so this is the problem, and this is how we're solving this problem. This is another problem. This is how we're solving this problem. And I mean, the opportunity is massive. And I think you understand this. If you watch my Voxter videos, you understand this. But what made me think about something is, I was thinking to myself, you know what, if we were just in a little bit of a more normal market, not retarded market, and if we were trading on NASDAQ instead of Toronto Stock Exchange Venture, I mean, Voxter would be valued at 2 to 3 billion today, because it was before the collapse. It was already valued close to $1 billion. You know, before people manufactured the recession in their heads. Now Voxter is so much better than what it was before. In a normal market, it would be valued $3 billion. Because why would it be valued at $3 billion? Because the value of companies is equal to the present value of future cash flows, right? Future cash flows. So the profitability, if the profitability is, let's say, a year or 2 years ahead, you're looking at the cash flow, future cash flows, and you would discount them to presence and you would get the value. That's why unprofitable companies with great long-term prospects are valued greatly by the market, right? But we don't get that benefit. We don't get investors looking at, oh, what's Voxter going to make, 10 years from now? No. It's 3 inches in front of their face. Tomorrow, is it going to be profitable tomorrow? It has to be profitable by Q4, otherwise it's Armageddon, right? 3 inches in front of people's face. It like looking at 2 years. I mean, come on, they don't have 3 inches is not 2 years, right? And if you look at something like Matterport has a market cap of $1 billion. $1 billion, right? It's also in real estate. And if you look at their financials, in 2021, they lost on a very, very net loss basis $340 million. In 2022, they lost more than $100 million. But that they got some credits here. If you look loss from operations, they lost $275 million in 2022, and loss from operations in 2021 was $148 million. So again, 2022, they lost almost $300 million on revenue of 136. Revenue is very comparable. very comparable to Voxter's revenue, Voxter didn't lose even close to this amount, right? And they are valued at $1 billion. Nobody seems to care whether they're going to be profitable next quarter, but still they get a valuation of $1 billion. Why? Well, because investors think that the future cash flows are going to be great and it justifies the price, right? But also Matterport trades on NASDAQ and Voxter trades on TSX Venture. Now, what I find very interesting is that what does venture stand for? So I looked up capital, venture capital. Venture capital is a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. Long-term growth potential, right? So in other words, venture money goes into companies that are new, that are not yet profitable, but will be profitable in the future, but they do have some value. Why? Because of the long-term potential, right? That's what venture is. Now, why am I talking about this? Because TSXV stands for Toronto Stock Exchange Venture. The companies that trade on Toronto Stock Exchange Venture are companies that are not yet at a level where they are mature. Those are the kind of companies that are not profitable yet, but they are there because they have long-term potential. That's why they're there. So why are we expecting from those companies to be like the Microsofts of the world, the Apples of the world, profitable, cash flowing? If you want that, why are you going to the venture exchange for that? Venture exchange is different. That's where venture capital goes. Why are we expecting venture companies to be mature? Because now investors change their mind, being like, you know what? I don't want those companies with long-term potential anymore. I want them to be profitable immediately. Well, that's problematic because you can't turn on a switch and become profitable right away, right? Now, Voxter is working really hard right now to become profitable, and they will become profitable, but then also at an expense of future growth because everybody is freaking out over this company being profitable, even though they go to a venture exchange to acquire it, right? But it's just, I just wanted to show you that in a normal environment, companies that have long-term potential are valued, they get respect, they get the patience from investors because they have long-term growth prospects. They have a path to profitability. Investors attach certain values to it. And if you are trading on NASDAQ, like Matterport is, seems like it doesn't matter that you're losing $300 million a year. They're still assigning valuation of $1 billion to it. If you're losing money, if you're losing a tiny bit of money, and you're trading on TSX Venture or Canadian Stock Exchange or OTC, it's Armageddon. It's Armageddon. You cannot be losing any money. You have to be to the standard of mature companies, even though you as a company are trading on a venture exchange. How crazy is that?